Welcome back. You're tuned into Bazaar Morning Call, and hopefully you're having a pretty good morning. Well, as promised, let's get straight to Mr. Amit Ramani, the Chairman and Managing Director at Awfis Space Solutions, who joins us on the show. Hi, Amit. Good morning. Good to see you in as always. And hoping that, you're safe and happy and, this asset quality, the air quality issue is not hurting too much. Well,
we're all dealing with it, Nigel. Thank you for your wishes.
All right. Let's get to business then, Amit. You have guided for a 30% growth, I think so, in FY26, if I got that number correct. And you're talking about a marginal increase in margins as well. If you could tell us, quantify what is the expansion you're looking at? Will you see 100 basis points, increase in margins, more than that? And also, will it largely be driven by seat additions? If you could help us out.
So, Nigel, I think the guidance that we had given for FY26 was, you're right, 30% growth on the revenue.
Okay.
On the margin side, what we had already achieved in FY25 was somewhere on the IGAP level, approximately about 14% EBITDA at the IGAP level and about 37% at the Ind AS level. I think they will remain flat because this was our guidance originally for FY26, which we had already achieved in FY25. In terms of the expansion of seats, we had given a guidance of about 40,000 seats, which we had added last year in FY25. That guidance remains the same for FY26 as well. In the H1, we added about 14,000 seats, and the plan is to add about 25,000 seats. If you look at the total seat, which includes basically centers live under fit out and LOI signed, that number stands at 170,000 seats and 8.4 million square feet across 247 centers. So we are well on track to achieve that in H2 and achieve our target of 175 total thousand seats live by March of 26.
I think now with this seat addition, you'll have to throw in the air purifier as well. Because
absolutely, that comes. Most of our centers have treated fresh air, so they're already matching the AQI of what's a habitable AQI.
Oh, interesting. All right. Good to know you're ahead on that front as well, because you can add seats, but the lungs are calling for some kind of relief. Anyway, let's talk about the other aspects of your business. What will the exit occupancies look like? On an average, I think it was around 74%. What's the target for the year?
Yeah, so for H1 average, it was 74% for the overall business. But if you look at the occupancy for 12 months or mature centers, it was at 84%. For the year, we will look at least a 1.5% improvement, so about 75 to 75.5% for the exit for the year. So clearly, I think the occupancies are improving, and the clear indicator for that is because when we added on a base of 95,000 seats, 40,000 seats, the young seats were much larger. Now, obviously, at the base of 135,000, when you add 40, the mature seats are more than the newer seats. So I think that occupancy will certainly go up.
Amit, hi. Good morning. Good to be speaking with you. So I want to discuss margin and the levers that you have as you go forward with the seat addition plan. And I believe you're also looking at other segments like hospitality, like retail. So just walk us through what the plans are on these newer segments and what happens to the margin, because you're at around 35-36% now, halfway through the year. So are these new segments margin accretive, or will, because there's build-outs and the fit-outs, initially will it be a little margin dilutive? So what are you thinking on these new segments?
So clearly, I think, Survi, one of the things that always we were asked was that, what is the margin in the co-working business and what's the margin in the fit-out design and build business? And so for that, what we did was we are in the process of basically subsidizing that design and build business into a separate entity. And what it does is it allows us to focus on that business independently and grow it on its own. As a result of this business transfer agreement that will happen as a part of the subsidization, the original co-working business will have a margin improvement, because obviously it will take out some of the operating expense that are kind of mixed between the two businesses into a separate entity. So I think the co-working and the managed office business will certainly see a positive improvement. If you look at the design and build business, it's a purely services-oriented business requiring very little capital other than some working capital. So clearly, it's a high ROCE business. So overall, at the company level, it will have an improvement. Also, we have introduced furniture. We have introduced today IT services. We have introduced mobility. All of these are service-oriented, requiring very little capital, and this will have certainly an improvement on the overall ROCE for the business.
So, Amit, this is really important. Can you give us some timelines? By when will the segregation, like you're saying, you want to keep the core business separate, which will be high margin. So by when will the segregation be complete? And all of these allied services, the additional services that you described, at sort of what margin will they operate? What I'm asking is basically 12 months down the line, somewhere in FY27, what will the listed entity look like in terms of the reorganization and the subsidiaries that you will create?
Yeah, so today about 75% of the business comes from the core co-working and the managed office business. In that 75%, about roughly 13% comes from allied services, right? Which includes basically IT services, mobility, and food and beverage, cafeteria management, those kinds of services. So those businesses, the allied services comes with a high margin. It's somewhere between 25 to 30%. And obviously that will have a positive impact as that continues to grow. In the co-working business, that allied services is tracking to about 18% of the overall revenue. In the managed office business, that is tracking to about 7-8%, blended at about 13%, which we plan to grow to almost 15 to 16% over the next 12 months. So they will have a positive impact. The 25% design and build business will get shifted into this subsidiary. And that subsidiary by itself is a high ROCE because there's no investment required. Currently, it tracks at somewhere around, I would say, at the contribution margin level, somewhere around 17.5 to 18%. As we continue to go into premiumization, that will have a positive impact as well, somewhere in the 20% plus range.
Amit, there's a SBI note, which there's the new labor codes which have been announced, right? Which have gone into effect. They say that they expect a 15% increase in formalization rate about jobs post the implementation of the 4 labor codes. Have you looked at this closely, or I mean, you're also reading the same reports. Any views on this? Whether this is going to increase overall employment, etc. Yeah,
it's a bit early days. We are having our teams review it, but to be, at least with the initial review, when I looked at it, we are already in the formalization mode, right? I mean, all of our teammates that are there already have, offer letters. They're already part of the, the labor code program that the government already has instilled. So I don't think it'll have any impact, but whatever impact, we will assess it and we will obviously report it back in the quarterly results.
No, I didn't mean for your cohort of people who are already with you. I meant like, does it kind of sort of boost? It goes down to the simple fact, will it allow and enable companies to hire more and do that kind of thing? That's the thing. But I guess
I look at it from I look at it from a very, very positive lens. I think it is the right thing for the labor force in this country. I think simplifying the code from multiple codes to 4 simple codes, and that creates a great opportunity for people to get into the formal sector. So absolutely a positive move as I see it.
Okay. All right, Amit. We'll leave it there. Thanks very much for joining us. Good luck. Appreciate it.